Let's talk about $80,000 a year of income. So if you think about an $80,000 income, that comes out to an hourly pay of about $38 an hour. If you're an individual that works 40 hours a week and you earn $80,000, that already puts you in the 67th percentile of income earners in this country. If you're a household that brings in $80,000, it puts you in the 49th percentile of household income earners in this country.
Yeah, I think this means you're dead square in the middle of America right now. $80,000 is right there at that median household income. So that means that, hey, you are making enough. And there's even the Princeton study from years ago that $75,000 was the happiness factor. And I always thought that term happiness seemed a little on the shaky ground, but I understood what they were trying to get at. Is that likely at this income, you're at least able to cover the foundation and hopefully have a little margin to even build on top of that. But it's still going to be tight. I mean, because look, but when we talk about take-home pay, a lot of these communities, if you think of cost of living areas, we've already compared and contrasted when we were talking about somebody versus Athens, Georgia versus LA. This is still, when you look at the national average on what, a two-bedroom apartment is, it's right around $1,900 a month. You can see your take-home is still going to be tight.
Yeah, you can see that at this income, at $80,000 of income, again, adjusting for the fact that there are payroll deductions and the taxes vary by state, on average is going to be about $5,700 per month. So it's obviously larger and more flexibility than you had at $40,000, but it's still, you have to be strategic with how you use your resources. And now maybe we are getting closer to that 50-30-20 breakdown. Maybe now we can think about 50% of our take home going towards our needs, 20% going towards our wants, and then 30% going towards savings.
And this ties in exactly what I was just talking about. Is if you look at that 50% needs, that means that we're going to have about $2,850 a month coming in, net of all the taxes and the withholdings. We talked about that in the disclaimer. But if your rent is close to $1,900 a month, that's only leaving a little right around $1,000 for all the other needs. That's just not a lot of wiggle room. That margin is still going to be tight, so you better be super, super direct with every dollar in your army of dollar bills.
And look, we understand, again, different parts of the country have different cost of living, so what we're modeling here is 50%. Your cost for your needs may be up to 60%. We recognize that, but again, you have to be diligent because when it comes to the wants, now you do have a little bit more margin. If you're going to think about that $5,700 monthly take home, and 20% of that is chiseled out for wants, that means it's about $1,140. So you do have a little bit more for flexibility. You're likely able to build up a little bit of margin on the side so that you can do those intermediate term goals like saving for that trip or maybe having a splurge here or there, so long as you're willing to make sure you're not letting your lifestyle creep out ahead of you.
This is where maybe we're now getting beyond the latte effect, where little decisions, nitpick decisions aren't making as big of a deal as they did for the $40,000 income household. But you still need to be very deliberate on what type of vacations you're driving, what type of cars you're driving. These decisions still have big results when you're thinking about building your army of dollar bills.
And then if the goal is to save 30% of our net, that's going to be about $1,710 on a monthly basis. If you actually look at the dollars based on the gross income, that's about a 26% savings rate. So it is very much possible to hit our 25% aspirational goal at this income level.
Yeah, there's some gamesmanship with how we looked at these numbers. Because remember, we're talking about when we say 30% savings, that's a net number. There's a lot of manipulation that goes into that with your tax rates, the state you live in, all the deductions that are coming out of your pay. We put 30 because if you do the math, just like Bo said, it came in very close to that 25% of gross income, which is the aspirational number that we want people to do. And where did we come up with that number? If you go to moneyguy.com/resources and you look at what your income by savings rate can do, you can quickly see that this stuff does intersect with the math. We're just trying to make sure we're very intentional with where do your behaviors fall into this as well.
And again, even at this income level, we want to make sure that we're honoring risk management. Your emergency fund with an $80,000 income is likely going to look differently than it did with a $40,000 income. So on average, we're thinking your emergency fund will likely fall somewhere between $17,000 and $34,000, again, depending on your unique circumstances. So if you're someone who finds yourself in this income range, what are the things that you ought to be thinking about, or what should your mind be focused on? And not incredibly dissimilar to someone at $40,000, you should know where your money is going. You should actually have a plan for your dollars rather than letting them escape and wondering where they went.
Yeah, for everybody who's watching the full show, not the highlight, I talked about when you make $40,000 household income, you have to know where every dollar is going. You have to budget. Just because your income is now up to $80,000, which is dead at the median for the United States, I still think you're budgeting. Yes, you have more margin, but you still have to know where every dollar is going, because this is a very purposeful period where what your behavior is, what your actions are with your army of dollars is going to yield big results.
Another thing that we believe you can do to set yourself up for success at this income range is automate. Automation is your best friend no matter where your income is, but certainly at this level where now you have the ability to have a little more flexibility, to have a little more margin. It's a little bit easier for your lifestyle to begin creeping. If you can automate your savings, you put a natural protection in there to prevent you from allowing you to get out above your skis. So make sure you're reviewing your automated process. And as your income increases, make sure so too does your savings increase.
Well, it also leans on that first ingredient of wealth building, which is discipline. If you automate the process, it does create a system of success to where hopefully these things are happening automatically. It doesn't matter what's going on in the stock market, all the emotional stuff that might be working in the background. This is just going to make it automatic for the people so that you hopefully one day wake up and you go, holy cow, all that hard work in the beginning when, yes, it was hard before I got all the pay raises, before my income went up even more, I automated the process to make the success as easy as possible.
And then another thing that you can do, another strategy you can implement at this income range is to use sinking funds. There's a good chance that you'll be able to fund small, short-term goals out of your cash flow, but for larger or more intermediate term goals, you probably need to save for them in advance. So this is things like replacing the automobile. This is things like going on that next vacation. If you know when generally the timing of those can be, using a sinking fund to begin slowly funding that goal can be incredibly valuable at this income range.
And this is another reason why that savings rate is going to be a little bit greater. Yes, we want a good chunk of this going towards long-term retirement type goals, but we also know that at 30% aspirational number is going to include these sinking funds and saving for what could be emergencies or just things that you also know are coming your way and you need to plan accordingly.